Hey, everybody, welcome back, welcome back. It's been a while since I did a video, and I can find no better reason to do a video than to discuss this up and coming FOMC statement on July 31st, 2019. Now, you can see that the forecast is for 225. And if we take a look at this number, we can see that right now the Fed funds rate remains at 250. Now, it's funny that they're putting in a quarter point decrease here because everybody's talking about the fact that they're looking for a 50-point decrease in the Fed funds rate. Now, kind of scary when you look at it like this, isn't it? Just look at that. Isn't that kind of scary? Remember in 2001 when interest rates were like 6% and 5%, right? Well, just keep these numbers in mind because it's going to actually, I'm going to actually expand on that. But as you can see here, we're looking for a quarter point interest rate cut. Now, if we go over to the countdown to the FOMC on CME Group, you see with 3 days left, so it'll be exactly Wednesday around this time, close to 2 o'clock. And the futures market is pricing in a 2 to 225. So, you know, they are pricing in the possibility of a 50-point rate cut, right? But what do I think is going to happen? I think it's going to be a quarter point rate cut, and I think that's all it's going to be, and I'll tell you why. So the real question is, how do we exploit this? What do we do about it? And, where are we right now? So in order to look at those things, I want to just take a look at some very important data that I follow and I track, and you should too, because it's really super important that you do. So on the first of the month, we are going to get out the non-manufacturing report. Now, if you don't know what the non-manufacturing is, that's non. I want to go to the first, manufacturing. The manufacturing report, basically this is one of the most important reports that you can follow because it is a predictor of GDP growth. And if you wonder what drives GDP growth, corporate earnings drive GDP growth. And you can see here before the financial crisis in 2008, that was on a downward trend, and boom, we had the big financial crisis. Now, you could say to me, Steve, well, there's been a few times in here, it's been also on a downward trend. But if you go and check the charts in 2016, we also did have a little mini correction. We had the big spike up here because this was due to the Trump tax cuts, and now we're back on a downward trend. Now, in reality, the market should follow this a lot more closely. And it should follow the ebbs and flows of the trends of this, okay? So the market should not have a correction unless this drops below 50. And how it ebbs and flows is really important. So you can see here, after they did QE and they did all the tax cuts, there was a period of economic growth, and then we dropped back down, and then there was an economic growth which could not make the highs of the previous high. And then finally, after the tax cuts, we've made these highs. So let's go take a look at the actual market and see what actually happened. In other words, what I'm trying to say is that if the Fed was out of the picture and they weren't acting like complete lunatics like they are, the market in the last 10 years should have done something along this lines. And this is where we should be right now. Somewhere around here, which would put us around the 200 level, okay? Now, that's where we should be, according to the reality of manufacturing growth and contraction in the U.S. economy and the U.S. markets. However, that is not where we are, right? If we look at a 10-year chart, by the way, I'm just going to mention this right here. This is a new algorithm that I'm working on right now. These signals, long and short, they recommend they're 5-day holding periods, 3 to 5 day holding periods. I'm absolutely loving it. It's a new algo. Everywhere you can see a short and a long here, down or up, is a 3 to 5 day holding period. It's just been absolutely brilliant. Loving it. I'll be doing more of this on my on my blog. If you don't follow me on StockTwits, I highly recommend that you do, because it's completely free. Can't lose anything. And I'll be doing more of those trades and reporting more of those trades in StockTwits. So I've actually been working on it on several different assets. They're short 5-day holding periods, and it's been working out really well on various assets. See, every time there's a signal. Works really great. Really excited about it. Okay, so getting back to the SPY. Okay, so now we have this big trend. So, does that look like that? It does not, does it? I'm not saying the market shouldn't be higher. What I'm saying is the market should not be at 300. It should be at 200. So we're extremely overvalued. Now you might say to me, but Steve, manufacturing is not important as it used to be. You're right. It isn't as important as it used to be. But what about non-manufacturing? Well, let's look at the overall trend at that. So over the last 10 years, again, if we were to draw manufacturing in like as if it was a chart, we should have something like this, we should have something like this, and arguably we'd be somewhere around there, right? So if you take somewhere in the middle between non-manufacturing and manufacturing, I think fair valuation for the market is probably around 230 to 250, okay? Now, I'm just a simple guy, folks. I use something that is rarely thought of anymore, which is called common sense. And that's the way I look at the world. Does it make sense? And it doesn't make sense that we are at these nosebleed levels, okay? Now, one of the things I want you to pay attention to here is notice the rate of change that we have done. What the market has done is it's gone slow, steady grind, correction back to value, slow, steady grind, correction back to value, long, steady grind. Now I want you to notice something here. Notice this rate of change. This angle is 34.2. This angle is 49.83. This angle is 39. This angle here is approximately 56. Now I want you to notice how fast this one has changed. That's a 74-degree angle. So, first of all, why the hell are we up here, right? Why are we here? Well, in order to understand why we're here and why we are so separated from the actual data and the cycle that we're in is because of the Fed. Make no mistake about it, the Fed and QE has caused this bubble. And for some unknown reason, they have become, not only the Fed, but every central banker in the world has become scared to death of normal cycles. That's right, I said it. They're scared to death of normal, healthy cycles. And they're doing everything in their power to keep a normal, healthy cycle from happening. And it became an addiction after 2009 when the market took a major correction, and this was supposed to be a temporary solution, was to cut interest rates and buy back assets and it was supposed to be a temporary solution in order to get the economy going again. But clearly, it has not worked. Okay, if we go and we check out GDP, which just reported on Friday, which was last July 31st. GDP came in at, was it Friday? Thursday, maybe. Friday, July. I lost my, this month. There we go. Sometimes I make these videos, I really should be more organized. So GDP came in at, advanced GDP, there we go, 2.1%. So let me ask you guys something. Has any of the QE worked so far? There you go. You could say yes because we're minus 6%. But are we setting record levels here? No. All it's doing is keeping things status quo. Right? And now we're on a downward trajectory again for GDP. So why in God's name, after 10 years of something not working, you can see before we did any of the QE, GDP was a lot stronger. Why are they insisting on letting it work or keeping up the stimulus? It's not working, and it hasn't worked for 10 years, other than keeping things status quo. So you can argue, well, that's good. But lowering interest rates is supposed to stimulate growth, which should stimulate GDP growth. It's not working. But they're addicted to it. Okay? It's become the norm now. What was supposed to be a temporary situation has become the norm. And not just for the Fed, but every central bank in the world. So, bottom line is this. Fair value to me is 220, 230. And when we jump back down here, I think that's where we should have been trading. But because of all this artificial stimulus, we're up here at 300. So what are you going to do on Wednesday when we do the report? Well, my point is this. My point is that we have separated from the norm. The rate of change in which the market has separated is the steepest that it has been in the last 10 years. What usually will follow in this situation is some type of climactic top with a very deep correction. Now, will that happen after Wednesday? I don't know. I really don't know. I wish I was good enough to tell you when the market will correct to what I believe is fair value, which is around 220. I don't know. I really don't know when that's going to happen. You know, I wish I was that good. And that's why I kind of focus on my shorter term trading strategies, because I do know what's going to happen in the next couple of days. I do know what's going to happen in 3 or 4 days and what's most likely to happen. And I'm good enough to do that. But I'm not good enough to predict the absolute top of any market. I can't tell you if it's going to happen after the Fed on Wednesday, or if it's going to shoot up to 325 and then come back down. I can tell you this though. We have separated from where we should be, including, there's nothing forward to look forward to. Like, the best thing that can happen now is a China deal. That could stimulate GDP growth. But China is in a shrinking GDP as well too. So even if that happens, I don't see it being sustainable. And I think the Fed has created this nightmare, because if they would have just let the market do what it should have done, and that was way back when we had, the market was at highs and we were 2009, if they would have just let it fall on its own without doing all that craziness, we would have slowly built ourselves back up to where we should be, which is 230. And then there would have been more room for upside potential. But right now, thanks to the Fed, we are devoid from reality. Again, guys, I'm just a simple man. I keep things simple. If you don't know what the ISM numbers are, I highly recommend you do a lot of research on it because they're very valuable in gauging future GDP growth. Okay? Thank you all. I hope you guys enjoyed that. Please join my Stock Twits room. I will share with you in my Stock Twits room. It's free. Floor Trader, look me up. I will share with you my short-term signals. And I'm up 28, 37. I can't even remember what I'm up right now in this room. This isn't exactly uh, matching my real performance. My real performance is actually better, but because I have to limit what I can do in this room, it's actually quite hard. I'm up 37.1%. In reality, I'm up about 45%. So this is actually less than my real performance, but I'll continue to post in this room and share with you my short-term trade ideas. And I really want to thank you all very much. And there's an update on what I expect to happen after the Fed. So what do I expect to happen? Bottom line, I expect the Fed to rate a quarter point. I expect after that quarter point, we could have a correction somewhere down to the 295, 293 area. But that won't get us all the way back down to where we should be. I think that if the China deal fails, if you put three scenarios together, the Fed does a quarter point, we don't get a China deal, and the trend of growth in corporate America, or economic growth in corporate America, continues on its downward trend, I think within 6 to 8 months we'll be back down at the 230 level, maybe longer. I can't tell the exact time. There you have it, folks. Hope you guys enjoyed that. Thank you all. Love you all. Bye for now.